Hello, and welcome to the Logistics Management Podcast Series. My name is Jeff Berman. I am Group News Editor for Logistics Management Magazine and the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome back Chris Rogers to our podcast. Chris serves as Head of Supply Chain Research for S&P Global Market Intelligence. Chris has more than 10 years of experience in building research businesses covering corporate decision-making and government policy in the supply chain and logistics sectors over at S&P Global. He also has held similar roles at Bloomberg and Flexport, a global freight forwarder based in San Francisco. Chris's prior experience includes power, gas, and emissions markets analysis at investment banks, including JP Morgan and UBS. And this also marks the third time Chris has joined us on our podcast. So, Chris, hope you're doing well. Welcome back.
Thanks for having me back, Jeff. It's great to be talking to you again.
Yeah, absolutely. Chris, this is the timing. Again, is good for us to connect, and I know we talk about all kinds of things and on a fairly regular basis based on your analysis, your data, report related to things like import activity and shipments across various vertical markets, sourcing issues, and really all things global logistics. So we'll jump into a lot of that today. But I thought a good place to start, Chris, would be sort of what you and I talk about on a monthly basis. And that's sort of, how do you view, Chris, sort of the current outlook when we view U.S. bound imports / shipments, sort of on, let's talk about it on a year-to-date basis, as we're almost closing the door here on the first 5 months of 2023.
Yeah, sure. So thanks for that. I think what we do with this data, and you've been very kind to feature it repeatedly in your newsletters, is use US bill of lading data to get a sense, not just in the aggregate, but also for specific product areas and industries, as to like what's actually driving these changes in the shipment levels that we're seeing. And what we like to do is to break those out into different industries. In total, year to date, so this is January 1st through April 30th, we're getting tooled up for the May data to come through in the next week or so. Year over year, we're looking at a reduction of around 17% year to date in total in terms of US inbound container freight handling.
Mm-hmm.
We've seen a pretty steady downturn over the past few months. Each of the months of the year so far have been down by that kind of double-digit amount. That probably won't be a surprise to any of your listeners. Experts in the industry, operators in the industry. There's the boats that are arriving at port are a bit emptier. There's fewer of them. So compared to the heady days of 2021. And 2020, we very much slowed down from that level. So that's kind of at the very high level.
Okay.
Yeah.
Great. And then, I know we talked about this a bit in the past. When we look ahead over the rest of the year, I guess kind of a two-part question, if you will. Do you sense that there will be any type of maybe material shift an increase in imports or shipments at any point throughout the second half? I guess that would be in tandem with perhaps something resembling maybe a more of a normal peak season, or return to a more normal peak season. Obviously, things have been shifted and changed significantly in recent years due to the impact of the pandemic, it seems.
Yeah. I mean, there's a lot to unpack in that, so I'll try and keep it kind of fairly short. I think the first thing to say is, going into the back end of the year, we don't expect volumes to recover significantly, but we do expect them to stabilize. So our forecast within our global trade analytics product shows containerized freight will still be down year over year in the third quarter, might be up a little bit in the fourth quarter. Now, when you think about what the big industries are that drive the trade volumes that we see, the dynamics for some of those aren't great. So if you look at consumer discretionary goods, so this is everything from TVs and furniture to exercise machines and apparel, those are all down double digit at the moment, year over year. And that's because consumer demand is weak. So that whole kind of, where do you see trade going is also a function of where do you see the consumer going. And, consumer spending's not been too bad, but companies are wanting to cut their inventories back, and many have done so, others haven't. We can talk about that a little bit later on as well. When you look at the industrial side of things, actually, so capital goods, so this is, machinery for factories in particular, that's actually been more robust. So
Okay.
the state of the manufacturing economy matters as well. So, we're down heavily at the moment. There's probably a little bit of light in the end of the tunnel at the end of the year. Hopefully it's not a train coming the other way.
Right. You had just mentioned inventories. Actually, I've been reading a bit about how a number of the large retailers, and I guess I'll use Target and Walmart as examples. They recently indicated they're starting to be able to, kind of draw down their inventories to what would be viewed as needed levels. And I guess, obviously they're exceptionally large retail shippers, companies, if you will. So they're probably they're probably the exception more than the norm, but the drawing down of inventories in general, is that something we can expect to see more of, or do we need to wait and see what happens with the condition of what happens with consumer demand?
Yeah, I think consumer demand is a big driver of that. I think if we look at the so S&P Global, we have the PMI, the Purchasing Manager Intentions Survey that we do. We've got a monthly update to that. When we look at, like, for global manufacturing, the stocks of finished goods are actually what we describe as being a neutral level, having been too high at the end of last year, then suddenly too low at the beginning of this year. So it is a very volatile pattern, and you're absolutely right. The different retailers are following very different routes. If we look at the apparel industry, for example, we're actually looking at slightly high inventories overall at the moment, but the fast fashion firms are actually lower than they were in the past. So there's a real kind of divergence going on there. But certainly, at the manufacturing level, we're kind of back to normal. But as always with things like inventories, you do get kind of phenomenal differences by specific sectors. You mentioned seasonality earlier, and you and I have talked on a monthly basis for years, right? And we always get to this time of year and it's like, what's happening ahead of the peak season? And we are starting to see some of those decisions be made, but certainly in the off-peak season, if we look at those US seaborne imports of goods, the pattern that we've seen, there's actually been an off-peak season this year, whereas there wasn't in 2021 or 2022. And that's why we had a lot of those problems around congestion and operational inefficiencies. So at least at the start of the year, things are looking like they're working normally.
Okay, great. I had reported on this recently, how here in the States, the Federal Reserve again ups the interest rate by another quarter point to 5.25%. It's his 10th consecutive rate hike. I think it's pretty interesting on a few different fronts. Obviously the objective is these rate hikes is to quell inflation. So I'm just wondering, how do you sort of view what's happening with the rate, not just this specific rate hike, but the rate hikes in general, in terms of, do you think it's one, lowering and actively working to lower inflation, but what does it mean for consumer confidence and spending? Because as the rates go up, people obviously could be more reluctant to spend, and obviously the consumer, as we always talk about, is the real driver of imports and economic momentum to a large degree. So how would you sort of view what's happening with that?
So I think so I mean, our colleagues in our economics team can kind of wax more lyrical than I can in this. I think a couple of points to make. One is, it doesn't seem likely that interest rates are going to come down anytime soon. That's not based on any kind of clever insights from our side. You just look at what the Federal Reserve board members are saying, and it's pretty clear that rates aren't going to come down, soon. Maybe not even this year. We might see, all this debate about whether there'll be a pause or not. I think one area where the US hasn't suffered as much as other countries is just the way that housing payments and mortgages work, right? Lots of people in the US refi at a very low rate over the past couple of years, and you don't need to worry about interest rates in your housing costs. It's just about your credit card and your car loan and that sort of stuff. Whereas in the rest of the world, if I take the UK as an example, where I'm based, our mortgages generally move with interest rates. So interest rate policy has been kind of more effective in slowing down spending more quickly. But when you look at consumer confidence, the University of Michigan survey, we saw a downturn there recently. And interestingly, people's inflation expectations inched up a little bit as well. So, if you're expecting inflation is going to stay higher and interest rates are going to stay higher, that's why you're moderating your spending. I think we should also say that higher interest rates and staying there for a while has a direct impact on supply chain decision making as well. Your finance director is not going to allow you to keep high inventories in the warehouse if that cash is costing money every day of the week. If you're using trade finance, obviously that's more expensive with interest rates being where they are now. The costs that you have to pay away for your trade finance will be kind of significantly higher as well. And then if you're looking to invest in other elements of rebuilding your supply chain resilience, whether that is changing your sourcing processes, investing in technology, research and development, we got a situation where money is tight for corporates as well as individuals. And in fact, if you look at the earnings of the S&P 500, those actually have fallen year over year for 2 straight quarters. So it's not just consumers, it's corporates that are going to deal with this environment.
No, 100%. I wanted to talk with you a bit, Chris, about U.S.-China relations, if you will. It's obviously there's clearly tension. The Biden administration has kept the Trump tariffs in place, as we've talked about before. And this has been echoed by the National Retail Federation in Washington, for example. Many people are of the school of thought that, for example, the tariffs have not done their desired stated goal, if you will. Many of them just view it as an additional tax on the cost of doing business. I don't want to make this a tariff sidetrack discussion, just on balance, which we did many times before COVID, because that was the big topic. But at the same time, if you can just quickly or maybe top level discuss the U.S.-China tension, and then maybe part 2, the current state of tariffs and where things stand with that today. I think that we can just leave it at that.
Yeah, so I think you're right. The debate has moved on since the Trump era, away from purely the mechanics of tariffs to a more kind of geostrategic rivalry between, I wouldn't just say it's not just the US, it's kind of, G7 bloc more broadly on the one hand, and, frankly put mainland China and others on the other side. Where it's being played out at the moment, though, really is very much around advanced electronics and kind of the fight for the future. So it's not so much around, where are the washing machines being made? It's more around where is the artificial intelligence being made and who controls those technologies. And that's where a lot of those tensions are at the moment. And that's actually where policy is playing out, whether it's, on the one hand, restrictions by the US, Japan, and the European Union on exports of computer chip manufacturing equipment, or whether it's the government of mainland China, on the other hand, finding that US chip manufacturers, are not companies that they necessarily want to work with, as we've seen with Micron Technologies recently. So it's much more complex than just trade. I think in the Trump era, it was very much just about trade.
Right.
The reason that matters is that it means it's all much more long-term and a lot knottier. To your second point about tariffs, the Biden administration have kept those tariffs in place. there seems to be very little sign of a desire to take them off. Here we're talking about the Section 301 tariffs that the
Yes.
administration applied a rate of 25% on most products, on a bunch of products, and 7.5% on a wider range. I mean, I haven't looked at numbers recently, but you're talking about probably somewhere between 25 and $30 billion worth of annual tariffs being earned through that, or being paid, I should say, through that process. So clearly, at a time of high inflation, taking those away would potentially help consumers. But on the other hand, it could hurt a lot of US businesses. Most businesses will say, look, we don't care if there's tariffs or not. We just need to know what they're going to be, and that they're going to either be around or be removed. It's the uncertainty that's the killer in terms of the business decision making. And I think as a result, the decision to just kind of leave them in place is probably kind of a better thing to do than to hint that they might disappear at some stage. That doesn't help anybody's supply chain planning.
No, understood. Yeah. And just to stick with the China theme here for a minute, when we talk a bit about, we've talked a bit over the years about sourcing / nearshoring, bringing production closer to home, increasing the domestic or regional supply chains. Is it likely that there could be more of a focus on nearshoring, sourcing, et cetera? Or are we going to see companies maybe reposition manufacturing operations out of China to somewhere else in Asia, whether it be, Vietnam, Thailand? It seems like there's a mix of things going on, not just one common thread or theme, if you will. But it seems like to a certain level, it seems like there's a bit more action than the traditional talk when it comes to these types of things.
Yeah, I think that's right. I mean, clearly with any reshoring decision or any sourcing decision more broadly, there's a lot of things that need to go into it. And a lot of the research we write investigates for a given product or industry or company that balance of the cost of production and the risk of production. And the risk isn't just, am I getting caught up in some geopolitical fight? It's, do I have secure access to to parts? Do I have a reasonable route for logistics? There's a lot of discussion about, okay, if I move my manufacturing of product X from just being in mainland China, do I move out of China altogether, or do I do a +1 or a +2 strategy? If I do a +1 or +2, do I want to go to Vietnam, where there's kind of lower risk but slightly higher risk cost than if I go to Bangladesh or Pakistan? Do I want to go to Mexico so I can access the USMCA trade deal? But if I do, I'm dealing with uncertain labor risks. Just because I'm not crossing the Atlantic, I've still got to cross the border, and there's been plenty of instances of train strikes and those sort of issues to deal with. So these are very difficult topics to deal with. It's often said, well, reshoring is not happening, you can't see it in the trade data. I would completely disagree with that. You can't see it at the aggregate level, but as soon as you drop down to specific products, you can absolutely see it all day long. We've done research just in the past month on power tools. You can see it happening there. With computers and printers, you can absolutely see it there. In kitchenware, in home appliances, the list goes on. So it is happening, but it's expensive and nobody wants to spend money at the moment, and it takes a long time. And we've just come out of a period of phenomenal volatility. So I think there's a lot more doing than there has been in the past 5 years. And I think that's encouraging, that companies are really taking positive control over their supply chain structures.
Okay, great. And that's interesting. That got me thinking, for people that are interested in taking a look at sort of the trade flows of certain verticals, commodities, et cetera. I mean, I know last time we talked a bit about apparel shipments. I can't remember. I think they were down. I can't remember by how much. But things like apparel, durable goods, CPG goods. What are some of the key? I know you track a ton of verticals, but what are the sort of the key ones that come to mind that can sort of serve maybe as a proxy for what's happening when we look at import levels, regardless of the direction they're going in?
Yeah, I think I often look at home furnishings and home appliances as
Mhm.
kind of a good test case for trade volumes. Why? Because they're great big boxes being moved around in even bigger boxes, right?
Yeah.
So they're a driver of trade. They're also assembled goods, so they've passed through a lot of different hands. Particularly if we're thinking about things like consumer electronics, where you've had to bring together a metal frame, a screen, a computer card, a lot of these different areas together. I think they're also areas where they involve manufacturing employment. So we've seen, for example, the Indian government have been really pushing to promote manufacturing, not just in mobile phones. And obviously, there's been a lot of discussion about Apple heading to India, for example, for manufacturing, not just for export, for also selling in India, but also in areas like textiles, where the government's providing a lot of support for new integrated manufacturing parks. So I think the consumer sector, there's a lot of exciting things going on in supply chain structures, even though right now the level and the volume of trade is actually kind of in decline after a real boom period. And I think that's an important point, right? If you're in a period of depressed demand, it's
Uh-huh.
a time where you want to look at your cost base, look at your operating structures, and see what you can do better.
Yeah, absolutely. And just to wrap up, Chris, I was just interested to get your take sort of on the container shipping segment, in terms of where things stand. When we look at sort of what the big carriers are up to. I There was always that saying, you can't build a church for Easter Sunday, and we always have seen and reported about sort of these post Panamax vessels that, but it seems kind of counterproductive to build these super duper large ships if the demand isn't going to hold up. And that's just one point I was interested in. But I mean, uh, I was interested in learning a bit about that in terms of where you see that heading, and also just in terms of the rates, because I know during COVID, container shipping rates, they were up nearly 20x in some cases, just astronomical. Obviously, those have come back down, but how does the current rate environment look? Are things sticking? What's happening there?
Wow, there's a whole other podcast in that altogether. But I think a couple of points to hit. Firstly, rates are way lower than they were. They're back to where they were before all the kind of craziness started. However, they
Yeah,
are still above where they were back in 2016. If you remember back then, we had the financial failure of Hanjin Shipping because rates had been low and because there'd been overinvestment in capacity. I'm not
yeah,
suggesting for 1 minute that that's what we're seeing now. If anything, you hear the container lines talk a lot more about pricing discipline. That's something we didn't see in the past. The building of these new ships, these bigger ships, are all about efficiency, whether that is operating efficiency, environmental efficiency. We're seeing a lot more multi-fuel move over to liquefied natural gas. I think the proof of the pudding in terms of these investments' effectiveness and the discipline in the market is whether we start to see scrapping of older vessels. If we start to see the stuff that's sub 10,000 TEU, maybe that was built more than 10 years ago, if that stuff starts being dismantled, then we'll know that the industry's really gotten itself sorted out in terms of its discipline, in terms of its capacity. In the meantime, there's plenty of levers that can be pulled, right? In terms of slow sailing, we've seen reports of that. In terms of blank sailings, we've seen plenty of that as well. So, I think as I say, there's a lot of capacity ordered. There's a lot to come, but I think the shift overs, it seems to be something that the industry is handling better. There'll always be the short-term issues to deal with. So right now we've got low water levels in the Panama Canal. That's going to require either rerouting, or smaller boats will go through, or the big boats that go through will have to go through less on them. It's a sad fact of life. There's always something with supply chains. If it's not the pandemic or a war, it's vessel fires and canal blockages.
yeah, yeah.
Always something to deal with, and always happy to help you and your readers and listeners understand them better.
No, that's great. And so this brings us to the end of our time for today's podcast, Chris. So on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I just want to again offer up a big thank you for spending some time with us today.
No, thanks very much for having me.
Yeah, absolutely. And we certainly will do it again in the future. For those in the audience that would like to keep up with what Chris is seeing in the market and what he's learning, please feel free to give him a follow on Twitter. That's is simply at Chris G.H. Rogers, and that's ROGERS. And also, please go ahead and give us a follow at Logistics Management. That's simply at Logistics MGMT. And I also forgot to mention that you can find Chris on LinkedIn as well. And for those of you that would like to subscribe to our podcast, simply wherever you receive your podcast or access your podcast, go ahead and look for Supply Chain 24/7, and it should pop right up. All right, everyone. Thanks for joining us. Have a great day, and we'll see you next time.